Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Mark Rzepczynski and I, Niels Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Mark, it is fantastic to be back with you this week. It feels like it's been a while. Can't remember when we last spoke, but how are you doing?
I'm doing well. It's fall foliage season up here in New England, and trees are turning color. It's a bright blue sky, so it's going to be a great day today. And I'm talking with you.
Oh, that's very kind of you to say. I've heard. I've never been to New England at this time of year, but I've heard that it is really spectacular the way the leaves turn and with all the woods you have around you.
Yes, it's a great time to be up in New England.
Good. Well, it's a great time to be listening to podcasts because you have provided a solid lineup of topics. It's not that the world is not giving us anything to talk about, I have to say, at the moment. So we'll be tackling those, some of them quite big topics, I think important ones, really. But before we dive into the main topics, and actually the next section might be a little bit more meat on than what we usually do, because I think you've got some great points also lined up for this section. I'd love to hear what's kind of been on your radar. What are you finding interesting at the moment? And it could be quite a number of different things. We don't have to just stick to one or two.
Sure. There's two things that really have fascinated me right now. One is just the issue of what is a safe asset, because we usually think of that as U.S. Treasuries as our safe asset. And I think that the sense of what is a safe asset is changing. Now, what does that mean? Is that in a crisis, or if you need cash, most investors would buy U.S. Treasuries, okay? But in some sense, there's no such thing as an absolute safe asset. It's all relative. And we'll sort of say that the relativity of what is safe is changing. A perfect example is that look at French debt. Would you consider that a safe asset right now?
Debatable.
Probably not. So if you look at UK debt, is that a safe asset? Because usually you think of sovereigns as safe asset. I don't know. We got a government shutdown in the U.S. We're reaching high levels of debt to GDP. Is the U.S. a safe asset? Treasuries? That's not clear either. And so the reason why I'm studying this, or why this is important, is because we've also been thinking about gold, and we've reached $4,000 an ounce in gold. You can say, well, why is this gold going crazy? Some would say, well, it's just a bubble, and they'll say, well, gold shouldn't be going up because inflation seems to be tamed relative to what it was 2 years ago. So there's no rational explanation for why gold should be going higher. But then what you look at is that what is the central banks doing with their reserves? They're actually buying up a lot of gold right now to increase the reserves in their foreign currency reserves. So what they're doing is diversifying out of some of the traditional safe assets and putting it into gold. And this is fundamentally different than what we saw in the 1990s, where they were actually reducing all of their gold exposure. Now, what that means is that gold is acting like a safe asset. Now, we know it's safety empirically because it'll sort of say it's uncorrelated with risky assets and, it does better in a crisis to some degree. It also is a good inflation hedge. But more importantly is that if you think that the traditional assets are less safe, then you're going to look for some other alternatives to diversify into. And that seems to be gold. It's very liquid. It may have as much liquidity as the treasury at times in the cash market. And so we'll see that relatively intelligent buyers, central banks, are buying gold. And what we actually see that this speculative exposure and the commodity commitment of traders from large speculators, their long positions have actually been declining over this period. So you can't sort of say that there's speculative excess from large buyers. It actually is from other groups, and I think it's a different perception of what role gold will serve in a portfolio.
Can I pause you here and just maybe ask a few questions around that? When you go back to the 70s and you just look at a chart, and actually this was something I picked up this morning from an article that the Wall Street Journal had about gold. And they have this long-term chart of gold going back to the 70s. And there's clearly there are three periods where the gold price really rise significantly. One was sort of 1978 through 1980. Then you had, it's not precise what I can see here, but then you had the time starting around the great financial crisis. So it may have started in 2007, probably lasted until, 2011, thereabouts. I think prices continued to move higher. And then, of course, we have now, again, where gold prices are really moving higher. So my question to you is there anything that you can think of that are kind of the common ground between those three periods? i.e., is it just, quote unquote, uncertainty that drives prices of gold? Is it something else? Is it a weak dollar? I haven't looked at the charts of the dollar, what it did during these periods of time. Or is it something else? Because I think then that begs the question, is this time different? Because both after the massive surge from around 600 all the way up to 3,500 or thereabouts back in the 70s, prices came down subsequently, quite dramatically actually, all the way down to, I think, 500 or something like that, which is, of course, around the time when the central banks were selling gold, interestingly enough. And then it goes up again. We reach around 2,500, 2,600 during the GFC. Then prices go down again. Not as dramatically, but pretty meaningfully. And then, of course, we have this big run-up. So I think a lot of investors are now thinking, okay, we have a great run-up, but if history is any guide, is this, something that is just temporary and we might see a massive correction again in gold price? I'm just trying to tie these things in together to see whether you feel or think or if there is something that makes this rally different from the other ones we've seen of this magnitude.
I'll answer this in two ways. First, let's look at what is the relationship between fundamentals and gold. And the reality is that we find is that, you expect if real rates are higher, gold price should go down. Okay, that works sometimes, but not always. We expect that this is supposed to be an inflation hedge. It is sort of, but then the link between when inflation occurs and when gold goes up is not that strong. So the link between uncertainty. We find that if uncertainty goes up, maybe look by the VIX or some uncertainty index, gold will also go up but it's not always as strong as what we would like. So it seems as though that the characteristics of what are the factors that drive gold is always in a state of flux. So now what does that mean for today? This is that it seems as though that there's a strong demand for gold. Is this a bubble? Hard to say. 20% move in let's say the last couple of weeks seems truly abnormal. Should the price of gold come down later on, or are we in a fundamentally different era? That's harder to call. Now, the reason why is because there are structural changes in the behavior of the gold market than what we saw prior. Okay. One is that we have now the central bank buyers, and central banks are sort of not price sensitive. They're doing their actions for other reasons other than profit motive. Okay, so that's taking out a lot of gold. There are certain countries that want to hold gold because the safe asset, U.S. Treasuries, may not be safe if, let's say, that you're on the wrong side of geopolitical issues relative to the U.S. or Western governments. Okay, so if you're, Russia, China, some other countries, you want to buy gold because you certainly can't say, well, I'll put some of my reserves in treasuries and keep them at the Federal Reserve Bank of New York. And then finally, we'll sort of say that there's been more of a financialization of gold. What I mean by that is that it used to be that you could maybe hold gold cash, in the actual bars, but that was really expensive. You had gold futures, but most investors were not able to buy gold. Now we have, ETFs available in a number of different forms. Some are, you actually have gold certificates as opposed to gold bars. But what you're finding out is it's a lot easier for people to use that. And if you buy it in ETF form, you can use that as collateral, which is key to being a safe asset. Also, the CME, for example, allows for gold to be held as collateral for margin. So if more institutions allow for gold to be used as collateral for loans, then it has more characteristics of the safe assets. So there's a structural change to this market that's going on that impacts how people will use gold in the future.
Yeah, no, I think that's right. And I think that one of the topics that I think we'll come back to in a second is that I find personally to be probably quite important in this respect. And that's this whole thing about ETFs, right? You and I are old enough in this industry to remember that when back in the 90s, for example, the way people reported on the managed futures CTA industry was this monthly printed magazine called MAR, Managed Account Reports, I think was yeah. And then I also remember, and this was like, it had a green color and it was, something you look forward to. And this is also where you could see the, performance tables. They were not available on the internet. You had to wait for them like 2 or 3 weeks after month end to get the performance numbers of the competition. But I don't know if you remember, Mark, but suddenly Lois Pells, who were the editor, they started publishing a new magazine called ETF, Exchange Traded Funds. And I just remember back then, I thought, why are they doing that? Why are they spending time on this? Managed futures is much more important. And boy, was I wrong. I mean, the whole ETF world is just incredible. And I think this is where I find it interesting, because here's the other thing. So we talked about gold. It's up, when I looked at the screen, up 46% this year. And you think, wow, that's great. That's really must be one of the best performers. Then you look at platinum, up 77%. Palladium, up 63%. Silver, up 59%. Okay, copper, not bad, 22% up. So my question to you is this a gold story? Is this a metal story? Is this the quote-unquote beginning of another commodity super cycle that we thought would have come, or experts thought would have come a few times by now? is that what's at play here? Or is it just uncertainty? People are not sure about their safe assets. How do you think about that?
Well, I think we're going to talk about this a little bit later when we talk about complex adaptive systems and connectedness and networks. But in some sense, is that this is a gold story, but gold cannot be viewed in isolation. You have to sort of say that it is connected with other stuff. And in some sense, you could sort of say that, well, if gold gets expensive, and people view that it's let's say higher than what they think is appropriate or fair value, then they'll say, well, maybe I should look for a substitute. Well, the substitute might be platinum, palladium, or silver, so that there's spillover effects in others. It's sort of, let's say that you could have one is your core market, and then you have satellites around the core that get pulled along by the behavior of one. And this is constantly what we're seeing in a lot of different markets, and that's the idea. And that's fundamentally to the idea when you think about a network of markets, is that there might be a shock or a driver in one market, but there are spillover effects to others that they get pulled along, and so there's a pull effect which is occurring in those. Now, if those other markets are less liquid, the pull effect could be much greater because there might be, for example, industrial uses. There's less volume of trading, so flow will matter. And so consequently, that you could have a bigger impact on some of these satellite markets relative to the core, which is still gold.
Yeah, no, very true. Now, again, I know we're going to be talking around these topics later on as well, but just one thing before I forget it. You said there are questions about, what is a safe asset, and you talked about the importance of liquidity, for example, that the gold market has a lot of liquidity. Now, of course, this is a completely biased comment, and this is something we've talked about over the years on the podcast, and that is, should we actually think differently? Should we start to think differently about what does this safe really mean, in a sense that instead of safe assets, should we think about safe strategies? And does the safety of a strategy, for example, come from being adaptive instead of long only, being diversified? So it's not just dependent on one outcome, being liquid instead of being tied up in just one thing, as you mentioned, government debt, for example. I don't know, it's a stretch because everybody can work out listening to this that actually fits trend following. So I know it's completely biased, but I actually think there's some validity to it. That these strategies, because of the way they're put together and what they consist of, in many respects, to me, feels a lot safer than, as you said, French debt, UK debt, US debt for that matter. Or something else, for that matter. Don't know if you want to talk about it now, but I just wanted not to forget it.
So there's some of the researchers who have worked on the issue of what is a safe asset, come up with an analogy. And they said that a safe asset is like a good friend. They're going to be there when you need them. Okay, so you can depend on them. So let me put it this way. If I need, safety and I got to get out of risky assets, then I could sort of say there's the liquidity available in treasuries that I could buy and sell what I want at a fair price. And it's sort of, and in that sense, it's a good friend. Okay, but as we could sort of say with all of your friends, some of your friends could be fickle. Okay, they may not be there when you need them. Okay, they may disappear on you. So because of that, we always have a set of friends. You have more than one friend. We diversify our friends. So when you think about, just as we think about that, we want to have diversification in our friends. We want to have diversification in these good friends called safe assets. We might also want to diversify across strategies to provide ourselves some downside. Now, it may be a silly analogy, but I think it's one way to think about what are you looking for from your good friend investment. So You want it to stay stable when you need it most.
But Mark,
You might not need more than one friend.
Well, I think it's the perfect analogy because you know what they say about the trend? It is your friend. So
There you go.
You hit it right. I think you hit it right on the nail. Okay, well, this is of course tied into one of the uncertainties and why some people say gold is going up is, for example, the uncertainty about, Fed independence, i.e. the Fed as a whole. And you pointed out there was an interesting speech, which I also heard about. I didn't hear the speech. I didn't read the speech from the Dallas Fed, Lori Logan. Tell us about that. Why is that important?
So Lori Logan has been the president for the Dallas Fed for not a long time, but she's been out there for a while. But she came from the New York Fed, where she was running the open market desk. So it's probably our top expert on we'll call it the plumbing of operating targets. So how does the Fed actually do what it's supposed to do? And what she said is that we're probably going to be in need for new operating targets beyond Fed funds. And she in her speech, she goes through that the operating targets has changed over time. We've non-borrowed reserves. We've looked at different forms of money, and then we've provided different signals. So up until 1994, the Fed never really gave any signals of what their actual policy was. Is that you would just have to, figure it out for yourself. So we use the Fed funds as our operating target by the Fed. But the Fed funds rate is now different than what it was, a few years ago. And number one is that the Fed engages in ample reserve management. There's more than enough reserves available. And because there's ample reserves, this is that they don't need to actually sort of go out and borrow reserves to meet their reserve requirement. So they get paid interest on their reserves that they hold in the Fed, so they can hold excess because it's not a true cost. So consequently, right now, the Fed funds market is actually, driven by, some foreign banks who are, buyers, and then the providers, which would be the Federal Home Loan banks. And so what happens is that as a operating target, the market is actually shrunk. It only trades about $100 billion, a day. And it doesn't represent the true money market rates that people are paying. So she said that, well, given these structural changes, the Fed is going to have to change, that they're going to have a new operating target. And that operating target, well, it could be SOFR, which is, the substitute for LIBOR. Or they said that probably a better measure would be, tri-party repo, overnight repo. So it's collateralized with treasuries. So it is a risk-free rate. And that using that as our operating target for the Fed, or moving to that, will better enable them to be able to manage, liquidity and flows in a crisis, perhaps send better signals for what the Fed is doing, and also be more representative of where the market is trading for short-term funds, because the amount that trades in overnight tri-party repo might be in the trillions.
Would that not? And again, I've heard about this recently as well, but not in any great detail. Would that not introduce somewhat more, quote unquote, uncertainty or volatility into the setting of, quote unquote, the Fed funds, or whatever we're going to be calling it?
Well, the tri-party repo is probably more volatile than Fed funds rate. Okay. But it also is more representative of the market. So it will be a measure that has more volatility, but at the same time, because it's a deeper, more liquid market, if the Fed says this is what we're going to use as our operating target, it will reduce some uncertainty, because it'll be a clearer signal, both as a receiver of the signal of where the market is at for short-term funds, and as well as a sender of signal that, okay, if this is what we're trying to manage or target, then it's it's clear that to all of those involved what that represents. So now this gets into the plumbing of money markets and plumbing of finance. But we still got to realize is that what is the driver of everything we do? And, it is the short-term interest rates. So what the Fed targets in the short term is going to have a massive impact of what's the cost of margin, what's the cost of collateral, what's the cost that we might face. And then there's so many other interest rates that are keyed off the operating target. So for a lot of laymen, you'd say like, well, okay, instead of calling it Fed funds, it'd be looking at, this tri-party repo agreement. How does that change my life? It may not, but for people who count their pennies every day on what their financing charges and what the signals that they receive from the Fed, this becomes important. And it's not something that's going to change immediately, but it's something to keep on the radar screen that structural changes is causing the Fed to change their behavior, and that's going to then impact on the behavior of other market participants.
Now, speaking of other market participants, we're also going to touch on retail and what's changing in that. But is there anything else you wanted to talk about in terms of monetary uncertainty and the summary of economic predictions? Is there anything, or do you want to jump to talk a little bit about kind of what's going on in terms of the retail market?
Well, there's two things I want to talk about: uncertainty, and one uncertainty that is overbearing on the market, and another type of uncertainty that I'll call a little scary because I'll call it ignorance uncertainty. Now, the monetary uncertainty is that you can use the SEP, which is a summary of economic projections, which comes out, quarterly, and it tells you what the Fed, president or Fed banks where they think rates are going to be in the future. Okay. Now, the whole idea of providing these SEPs is that then it should reduce uncertainty, because then we have a clear idea of what they think the forecast of the future path of Fed funds rate, or where the future path of rates are going to go. Now, so you say like, oh, this should reduce uncertainty because by giving more information to the marketplace, then they know what's going on, and they know what's going on in the head of the Fed. Now, if you look at the September SEP that came out, this is that the Fed forecasts of what interest rates are going to be over the next year are all over the map. They've got people actually, some raising rates, some keeping the same, some big move down lower or not. So in an effort to provide clarity on what the Fed is thinking, they've now told us that they have no idea what they're thinking. They have a high amount of uncertainty, and that sort of has an impact on all of other trading. If you're saying this is the central banks have no idea what they think the rates should be or what they'd like them to be, well, then that's going to cause a lot of difference between buyer and seller opinions, and it's going to cause more volume. So that's just hanging over the market. Now, the other issue that scared me is that there was an interesting paper from the IMF. Okay, now I need to get a hobby if I'm spending my time on reading some of these papers, but it's called Perceptions of Public Debt and Policy Evidence from Cross-Country Surveys. So what the IMF did is that they did a survey of 27,000 respondents, and they were asking them some simple questions about the relationship between spending, taxes, and deficits, and the impact on deficits and debt. So they said, okay, if spending increases, what will happen to deficits? Okay, and then they asked the other question: if spending decreases, what happens to deficits? Then they asked the same question about taxes and then deficits. And you sort of say, like, if I told you spending increases, all things equal, what do you think is going to happen to deficits? I'm not going to put you on the spot, but my guess is that with almost 100% accuracy, you'll say if spending increases, deficits will also increase. Now, the scary part when you look at this, it's of the 27,000 respondents, is that just over 50% of the people got this right. Okay, so if you ask if taxes increase, what will happen to deficits? Again, some countries are better than others because they broke it down by countries. But in many cases, it's just over 50% that got it right. So, this is scary because your average person has no idea what is the link between spending, taxes, deficits, and ultimately the amount of debt that we have outstanding. And if we don't understand that basics, and then you say we've got a lot of debt outstanding, the likelihood that we're going to have a credit crisis is going to be a lot greater just because we don't have the knowledge to understand what are the linkages that drive debt in the world.
Yeah, no, absolutely. Well, let's jump to something that became very top of mind during the last crisis, and that's actually the power of retail. I think sort of during the pandemic, we started to see the first signs of how retail investors back then in a few meme stocks really had a big impact in the market. But this has changed dramatically since then, and it continues to change, not least with the amount of new products that are being issued. Tell me where your thoughts are on this, and I'll add a few thoughts as well.
Well, my initial thought is that I'm not sure. So now you have a lot of people who are trading, and I think the thing that really scared me, if we look at our very short-dated option expirations, is that before 2020 there was daily volume of about 20 million contracts. Now it's well over 60 plus million. So you have this huge impact from short-term option trading. We have a tremendous amount of flows into ETF. And so when you think about it is that those flows that go in can also flow out fairly quickly. So that's going to have a big market impact. And it generally has been viewed that the retail traders or retail investors, are either, last to get in, sort of miss market moves, if researchers would sometimes refer to them as noise traders, that they add noise to the market. And so the question comes in is that if we increase the amount of noise, how does that change people's behavior and models? How does that change pricing behavior? We do know that the simple fact is that if you use prices as signals of value, but if noise increases, then those signals are going to get distorted. And so the question comes in is that we know this is going on. Now, how do we adjust our behavior because of that? And that's an ongoing issue and for research.
Yeah, no, I think this is actually very important, and I think that this is a key topic that I think many of our colleagues in this industry think about in terms of the data they use and so on and so forth. I was thinking about this also in light of the recent interview that Jem did with the co-founder and CEO of Robinhood, Vlad Tenev, where they sat down and he talked about some of the new things they're rolling out. And of course, they were very much kind of in the forefront of getting retail back in the market, so to speak, with free commission, quote unquote free commission trading and so on and so forth. But of course now they're adding other things like prediction markets, where it's not just about financial markets. You can bet on college basketball or whatever it may be. And of course, oddly enough, being Danish, when I watch television in Denmark now, I would say about almost half the advertising on television is purely from betting firms. And of course, this has been sports betting. So, I mean, it's real. I'm not so sure it's healthy to give people too many betting tools, so to speak. But it's definitely a big part of what's this revolution, and as you say, it will add at least noise, if not something else. And then, kind of going back to our to the maybe the next point you brought up in your notes, which is something that Andrew and I touched on only briefly, a couple of weeks ago, which is this thing about inelastic markets and how flows impact markets. So I'd love to hear your thoughts on this, because we didn't do a great job in terms of going into the actual details. We just talked about and referred to a lunch interview between the FT and the chairman of CFM, who has become a very big proponent, as I understand it, of this inelastic market hypothesis. So you probably know much more about this than I do. So what are your thoughts on this, and how does it tie into some of the things we just talked about?
Well, just to close the loop on the retail issue, it's interesting that Terry Duffy, the head of the CME, had a podcast where they talked about their rollout of their venture with FanDuel. So the idea to get more retail investors to trade at the CME. So this intersection between we'll call it betting markets, prediction markets, and traditional futures markets, they're getting more closely aligned. And so on one level is said to this is part of further innovation in financial products, and what we'll sort of say is a very competitive business. Finance has been very good at providing innovation. The issue is that not every innovation is good. And, we'll sort of say that some innovation will have unintended consequences that we need to be aware of. Now, talking about this inelastic trading, which is one of the topics for your last podcast, and I think it's very important, because the idea is that from inelastic trading is markets are not efficient. That in reality is that market can be inelastic, or the elasticity changes across markets because of the volume that you trade or the flows that you trade have an impact on price. And that volume in a given period of time might actually be very large relative to the volume that you usually look at in a time packet. So therefore, it could be really have a strong impact that causes more volatility in markets. And similarly is that we need to look at the actual players in the market, because their elasticities will be different from player to player. So if you take a mutual fund that has a focus in stocks, if they have flows that come in, they're going to have to invest in stocks. A hedge fund might be focused in a specific sector, so they have capital to put to use, but their elasticity is going to be based on what is their mandate or the objective of their fund. So if you think about it, is that the market is filled with different agents or different market participants, each that have different objective functions. And because their objective functions are different, they may not always be able to provide capital at a given point in time in a way that would keep the market efficient. So hence is that the composition of the market matters. And because the composition is affected by the flow matters, and flow will then affect prices. I think from the retail perspective is that if this represents a different set of flows, or the flows come at different times of the day, or represent trades based on a different set of beliefs or expectations, then that could have an impact on price, which could cause it to differ from what you might think is the efficient price.
Yeah. Speaking about, before we jump on to something we normally get done with in the first 10, 15 minutes, which is the trend following update, but this is great. This is fun. You talked about financial innovation and all of that stuff, and kind of how it relates to the retail space. Actually, I think also financial innovation has been part of one of the headlines that I just caught, and I'm sure other people did, which is not some topic necessarily that I know a lot about. But I do remember, and maybe this was kind of a result of hedge funds, alternative investments not doing great a few years ago. I can't remember exactly, but suddenly this thing called trade finance popped up, and oh yeah, this is great. I mean, you can lend, you can invest in these funds that do trade finance, kind of like like a hedge fund type strategy, and you'll get very steady, very decent, maybe double-digit returns. So to me, I feel it was mentioned as some kind of low-risk strategy. What could possibly go wrong when you loan money to people who can't get their trade financed elsewhere? But of course, this week we hear about something called First Brands and its bankruptcy. And then you start seeing some of the fallout. For example, and again, I'm just quoting the news, so I'm not making any judgment here, but there was a UBS fund that turned out to have 30% of its portfolio tied to the failed First Brand group. You have Jeffries, as far as I can tell from the news flow, also being impacted by this. Again, maybe the financial losses are not too excessive compared to other things, but certainly reputation-wise, you can quickly lose out. So sometimes these things, and I think this might only be the beginning. I'm sure there are many other fund strategies that do something like this, and there might be more to come. But it just shows, or it reminds me of this, how these narratives can have a big impact in terms of how products are being positioned, how they're sold. But things like, again, going back to our little world, trend following, where, you see the volatility every day. So that's why people don't really like it. But it's rare that we have any really bad surprises. I can't really think of any in the last 35 years that I've been part of this, where something happened that you wouldn't expect. I mean, you expect volatility in these strategies. So, anyways, I don't know where I wanted to go with this, other than to comment that these financial innovations are not always good.
Well, trade financing or factor financing has been around for hundreds of years. It's not a new innovation, and a lot of people think
it's the packaging, though, Mark. Right?
Yes, everyone thinks, well, it offers you a stable returns, but then then made the next comment was, well, what could go wrong?
Right.
So banks were very much involved in we'll call it trade finance and to some degree, factoring. This is bread and butter, but it's actually very people intensive, and there's intensive credit work, because if you say I'm going to lend against inventory, at some point I'm going to have to send an accountant out to some warehouse, and I'm going to have to look what's in their warehouse. And in case of First Brands, it was that they're in auto parts. They do windshield wipers. Someone's going to have to count all of the windshield wipers in the warehouse, and he has to find out, is that my collateral, or is you use that collateral for 5 other different loans? This has been going on for traditional, futures for a very long time, because we'll sort of say that working for the Mercantile Exchange in the 80s at one time, this is that. What you find is that there is a whole department that you have to do. Is like you have to go out to warehouses and actually check to see where do you have the warehouse receipts? Is there livestock in at the delivery point? Is there grain in the grain elevator? Is this that you have to actually do all of this? And it's actually very expensive to do this. So, and the one thing you need to remember about lending is that you need a lot of good loans to make up for one bad loan. But the important part of futures that I think that people, sometimes forget is that what is the tremendous innovation that's been associated with futures markets since its inception with daily mark to market? This is that you have to settle up every day in terms of your margin. If prices go up, and you happen to be on the short side, you might have to be required to post more margin funds. And so that's done on a daily basis. And so, a lot of this lending wouldn't happen if, let's say, that you actually had to, we need, if we knew exactly what the collateral was and what margin had to be posted associated with on a daily basis. It's a little bit of stretch, but I think that this is important to say how markets differ structurally.
Yes, and not to take any shine away from the futures markets because I love them, but I'm sure you remember also that there have been occasions where, wasn't there a point, and I forget which metal it was, where they discovered that actually the metal was not in the bags in the warehouse. It was like, scrap metal rather than
the nickel,
copper or nickel. Yeah, it was nickel. So, anyways, not perfect, but a lot better than many other stuff.
There was the classic case of like the salad oil or the soybean oil, where actually what happens is that they said they had the collateral and it was in big tanks. And so what happens is that people would usually test for whether there was actually the collateral by dipping a stick in and sort of saying, okay, is the oil there? Well, what happened is they filled the tank with water, which is heavier, so that was on the bottom. So if you tested from the top, you said, oh, there's the oil there. It's legitimately there when it didn't exist. So there are some vast stories of fraud going on, in even in the futures markets.
Absolutely. Okay, all right. Let's move on quickly to a quick update on the trend following side. I mean, Alan mentioned last week that it was a tremendous month of September. We're fortunate that this momentum seems to have continued pretty strong so far this week into Q4, which I'm always thinking of Q4 as not a bad quarter for trend following. I'm not entirely sure, but I don't have any data necessarily to base it on. But as I said, I think the so far things are moving nicely. Again, with the momentum in some of these markets we've talked about continuing. What I specifically just wanted to mention about September that I found to be really nice is that we live in a world where there's so much talk about AI and how these new innovations like technologies are going to change everything, including making it really difficult for old school trend investment strategies like trend following to make money and flourish and all of that stuff. But then you see gold up 10%, 10.2%, I think it was in September. That's the largest monthly move since the introduction of the futures market in 1974. And it just provides a great opportunity for old school trend following to really capitalize on that. So even these old style strategies, I think, are so relevant today, as relevant as they've ever been, frankly, in my mind. Quick run through of the numbers. So we are using numbers as of Tuesday this week, the 7th, because they haven't been published yet for the 8th. But Beta 50 off to a good start in October, up 1.22%, now up 1.68% for the year after so many months of having negative numbers. Year to date, we're now, for the Beta 50 at least, into positive territory. SocGen CTA index up 1.19%, down a fraction still, 1.54% for the year. SocGen trend up another 1.6%, down only 71 basis points as of Tuesday. And the short-term traders index still struggling a little bit, but up 73 basis points in October, down 4.42% so far. I will add to that I think yesterday was a very strong day for CTAs. So some of these numbers may be very close to flat, if not positive by now. In the traditional world, of course, there's no comparison, I have to completely admit. 1.1% up already for the MSCI as of last night, up 19.1% for the year. S&P US Aggregate Bond Index up 20 basis points in October, and up 4.5% so far this year. And the S&P 500 total return up 1% as of last night, and up 15.98% so far this year. Now, we have gone quite long in our quote-unquote early part of our normal conversation. So maybe with another 20 minutes or so left of our conversation, Mark, I will let you guide us which of these topics that you mentioned to me you wanted to deal with, because I don't think we're going to get through all of them. So would you mind telling us where we're heading now in the conversation?
Sure. There are probably two issues that I want to try to talk about. One is a nice piece of research from Quantica, the CTA, which looks at alternative versus traditional assets, which is an ongoing discussion we've had in the past, but I think that they're added to the discussion. And then second is talk a little bit about this, networks and complex adaptive systems, because this is an issue that I've been spending a lot of time on. And I think that I want to, if anything, maybe provide a little bit of teaser for what the research I'm working on, what I'm trying to achieve, and tell you why this is a hard problem. But if I solve it, it actually could have big benefits. So,
okay, cool. Very good.
So let's talk a little bit about the idea that what this research that I was reading out that came out about last week or 2 weeks. So traditionally, the futures has been this big issue is how many markets should you trade? Should you trade more or less markets? And so there's probably one group that says, let's stick to a core group, keep the most liquid markets. That's all you need to do to be a good CTA trend follower. And the other group has been said is that, no, you want to add a lot of these, what they call alternative, which are sort of the smaller, more esoteric futures or other markets that you could trade, because that's where the, no pun, that's where the gold is, these are the hidden opportunities. So what happened is that, Quantica did the research, and what they showed is that these alternatives for a good 10 years was adding a significant amount of value added to the portfolio, that they had high Sharpe ratios and that they were low correlated, so that the combination of the two sort of, provided a nice tailwind for trend followers. But now more recently is that they said that those performance of those alternative markets has been less than what we'll sort of say that the core markets or the more traditional assets. So the performance has declined. And so now it has been more of not of a tailwind, but it's been more of a headwind, that having more diversification or adding these alternative markets has had a negative impact. So then, of course, the issue is that, well, what's the optimal number that you should have? And, that's the age-old question of what we're seeing. And I sort of said that they didn't really touch on this, but I think it's the issue is that the behavior of money flows from trend followers to different markets will have an impact on the efficiency of that market. So notice we talked earlier in this idea about the inelastic, market hypothesis. This is that what we're saying is that markets are not always elastic, is that the flows matter. Well, if you had for a long period of time more and more CTAs entering in these less liquid markets, these alternative markets, by definition is that their flows are going to impact the behavior of those markets, such that where they could have been profitable before, they could become less profitable now because the composition of the market has changed.
So is this what we often talk about as market impact?
Yeah, and so this is the really important part that uh, especially as you get larger, which are those are the CTAs that you would that institutional investors or even retail will invest, is that some of these are becoming larger and larger. They become billions of dollars. Now, a large trend following CTA that has $1 billion of actual cash, their notional value is going to be a lot larger. So their market footprint or market impact is going to be a lot larger. And I probably would sort of say that when we look at all the back testing that's done, you could have the perfect back test, but you also have to, account for your market footprint. What is the impact of what your trading has been? And that will sort of say is that it's not the cost of the bid-ask spread. It's not the trading costs. It's the market footprint or impact that really drives performance. And so the battle of a CTA is not now as much trying to find out what is the next model to find trends. I'm not sort of saying that that's solved, but we have a pretty good idea of what we think, how we can identify signals. We can identify what is a trend. You might sort of say that sometimes very long-term does better, sometimes short-term does better. Sweet spot is the intermediate. You could sort of talk, there's slight different ways of doing this, but the big battle from a research perspective and from a success of a CTA is how can they reduce their market impact, their market footprint, while still adding more assets under management. So as I grow, my footprint gets larger, and now I got to fight this growth versus the market impact effects. So
Now,
this is what the research battle is all about right now.
now, given what you just said, and I don't know if this can be concluded, but isn't there a big risk now with the popularity that these alternative markets attracted, not just from more managers doing it, but of course also from investors, buying into the narrative, so to speak? Isn't there a chance that this has had permanent damage, that we have too much money now in those markets, and they're simply not able to, on an average basis, let's call it that, cope with these much larger flows to avoid having a negative market impact? Now, I'm fully aware there will be times where the trends are just so strong that market impact is overcome. But that's why I wanted to say, on average, that at least perhaps too much money now is chasing these markets, or is that a step too far to go?
Well, you can answer it two ways. I could say, yes, there is too much money following it with similar strategies. And so a number of large brokerage firms, some of the French banks, for example, have now CTA trackers. Large investment banks also have trackers. What they do is they run, trend following models, and then they sort of look to see like where's the big flows going into. So they anticipate where flows are going into. So it's almost as though that we know that you have a big footprint. We know that you have, you're disturbing the system. So what we're going to do is track you so we can then be able to anticipate that and then be able to trade either with or against it. So there's
that
actually
what
a feedback
in the old days,
mechanism.
Mark? Right. In the old days, we called it front running, didn't we?
Heaven forbid we would say something like that, but I had an interesting discussion back at John Henry. They say like we were, and it was sort of a cheeky comment. He said like John would go, "Why are all these brokerage firms? Why do they want to come down here and want to see our business? Why do they want to have us trade with them? And why are they willing to do this at just such low prices?" Now he knew full well what they were thinking. They said,
course.
"Well, they wanted to see our flow, because then they can sort of say like, well, if I have that I wouldn't break the law, but let me put it this way, it gives me a huge advantage if I see when large CTAs would be coming in with large orders, and even if I don't profit from it, if I know that the freight train is coming down the track and I know to step off the track for a while because they're going to get hit by the train, that is the tremendous advantage you could have vis-a-vis the other competitors who might be trading in the marketplace.
Yeah. And of course, I mean, the fact that data, order data, whatever it's called, is sold, and firms today are profiting from buying that data from various platforms. And it's a real thing. And of course, you and I know that in the press, relatively often, you're going to see these articles where so-and-so investment bank is out saying, oh, if the S&P does this, then CTAs will have to sell, 80 million worth of equities, whatever. So, yeah, it's definitely a thing. And not, as I'm sure people know from listening to me in the past, that I'm not a great fan of the shops that we place our trades with, whether or not they're Chinese walls or not, that they are so public about these things.
Well, the important part in this one is that we spent a lot of time talking about that we'll sort of say that the sweet spot for most trend followers is sort of an intermediate trend, a couple weeks, so that that long term is also very good too, but short term not so much. But I would sort of say if you're a larger, and even if you're a smaller CTAs, is that all of the research, or we'll say that every CTA is a short-term trader. And what I mean by that is that how you actually execute your orders, so how you allow your orders to enter the market, how you trade, how you sort of impact or try to minimize your impact on flow, it will have a appreciable impact on your performance. Now, when you think about it, is that CTAs will have great double-digit years. There's other years in which you're going to have single digits, or you'll have modest returns. If you can be able to cut your market impact costs by 1% to 2%, that in some years could represent a significant portion of your overall returns. And this has an impact even as though that, people will test models based on, okay, I'm going to execute market on close. Well, market on close still has a market impact because, it is a market clearing price and you get the price on close. But that doesn't mean that it doesn't have market impact relative to what the price may have been a half hour earlier. And so I would probably sort of say that when you're doing some equity trading, we spend a tremendous amount of time is that we are looking at, shorter term trading about like, what do you do in the first 10 minutes of trading? What do you do in the first half hour? How do you VWAP the trades? What happens a half hour before the close? What happens 10 minutes before close? What happens at the close? So we could spend, and a complete, podcast on just the microstructure of markets and how you have to behave, even if you're a trend follower that's looking at longer term trends on this topic.
One thing I want to clarify, you talked about how a lot of people think, I don't know if it was your opinion or whether just a general observation, is that a lot of people think that kind of medium term is kind of the sweet spot for trend following. All I just want to say is that that's not what our research show. And so I just want to make that clear. I think it's a common understanding that, maybe short term is a bit too short, so you have too many transaction costs. So over time, you can see that short-term trading. You can just see it in the SocGen short-term traders index. I mean, it hasn't made money for a long time. And then you can look at sort of longer-term trend following, and yes, it's been the most profitable in our research. But of course, there's also a cost to it. Maybe a little bit more volatility, sometimes high drawdowns. But So that's what our data finds. But I just want to say that these things change over time, and there certainly was up until the last 2-3 years some nice opportunities in the quote unquote medium term space when we look at it. But the last 2 or 3 years, probably medium term has been the hardest hit of these kind of different speeds of trend following. And I think from my recent travels last week, I think a lot of investors are waking up to that. And maybe you shouldn't pick a manager that is too focused on and too set on a specific time frame, but actually, being adaptive even when it comes to speed is quite important. That's a side topic, so I don't want to go down that road. I do want to go down. Okay.
I was going to say that you're absolutely right. For a long-term high return performance, the longer-term trends do better, albeit you're going to have to take some more, risk to do it. But the key point that you make is that no one strategy in trend following world always does well. So if ever there was the reason for diversification, it's because nothing works all of the time. So as we see with this alternative versus traditional assets, alternative does very well. No, it's not so well. So that's why I always think in terms of this sort of a three-dimensional diversification. It's style, timing, and markets. You got to sort of say how do you make sure you fit over different time horizons? How do you fit across different markets and then slightly different styles? You got to diversify.
Yeah, you got to diversify. Okay, so the last topic we're going to get to is what you mentioned you wanted to spend a little bit of time on as well. Of course, I should have my buddy Rich here for anything that mentions the word complex adaptive systems. That's kind of his one of his pet peeve that he loves to talk about and knows a lot more about than I do. So tell me where we're going with this. And because you said it is potentially something that is very, very important.
Well, we'll sort of say the tremendous benefit, but then the tremendous, we'll sort of say, potential problem with trend following is the fact that, trend following is very good about isolating exactly what it looks at and then sort of throwing out all of what they consider extraneous information. What do we mean by that? Is that you don't care about what the fundamentals are. All you care about is price signals. Okay. The big issue in finance is always what we call now causal inferences. What are the causes of what causes what are the causes for why markets move? A trend follower says, I'm not interested in causal inference. All I care about is the prices are going up or down. I'm a reactive. I'm not looking for the fundamentals. Okay. And finally, we'll sort of say the trend follower says if I'm putting a trend model and there are variations, so I'm not sort of saying this depicts everyone. If I'm looking at the trends in gold, I don't really care what happens to the dollar at the same time. I don't sort of say what happens to the dollar will have an impact on how I trade gold. I sort of say, I isolate this and I look at it as an independent market. I isolate and forget the fundamentals. I isolate and say I don't look about causal inferences. I just do what I do very well, which is just to pick up the signals and then execute on that. Okay, that's the reason for being and why it is successful. So now the question is but can we improve and make this better? So the whole idea of thinking in terms of a network is that, or a complex adaptive system, is that, if I'm looking at the gold market, doesn't the dollar have something to do with what's going on in gold? So if there's a trend in dollar, that it may tell me something about what or have an impact on what will happen to the gold market. So let's go back to our idea of flows. Flows out of the dollar may flow into the gold market. Okay, the behavior of the gold of the dollar market may have something to tell us. It may be, sort of causal prior to what might be happening in the gold market. And so if I look at this as a system, as a network of markets, that those markets may be interrelated, and at the influence of one market, because of its flows in and out, because of its behavior, because of its volatility, will then have an influence on another market. So we have to think of this as a more richer, complex system. This is not an easy problem to deal with. So, so I'm not saying I solved it, but I think that that's what we want to try to say, is that if you could sort of find those connections and realize that they're nonlinear, they're episodic, so they don't happen all the time. So, which means you're going to need a lot of data and a lot of computing power. You're going to have to use some sort of, let's say, complex, sort of machine learning techniques to extract this information. But if you could do that, then you can create an edge that may not have existed before. So that's what we think that we're trying to look at. And I want to leave the listeners with the idea that should you look at markets in isolation, or should you sort of see like what is the connectedness across markets? And then if you think that they are connected, which I do, then you say, is there a way that you could maybe find a way to exploit that connectedness?
Yeah. But just to be clear here, Mark, though, I mean, isn't that something we've always known? And a lot of people have, I wouldn't say a lot, but there are certainly managers out there today who does not just generate their signals based on an individual market move. They will do cross-sectional momentum analysis or whatever we define it as. Maybe the challenge is still to find something that we can, because these relationships change. So again, that's part of the problem. So maybe we can become better at it, more precise at it, know when these connectivenesses are changing or breaking down, etc.
No.
But I don't know that it's new that there are relationships that can be exploited by CTAs, because I think some people do that. We don't. At Dun, we don't, but certainly. And also this principal component analysis type stuff that might have an influence as well.
You're absolutely right. This is not a new problem. So
Right.
it's not. I don't want to sort of people think that, okay, I'm the first person to discover this. We do this with some time series when we look at whether markets are co-integrated. So that's one simple way to do it, and it's whether are two markets related by, or are they co-integrated? Okay. But we're sort of saying is that we're not looking at just the co-integration, which is we're looking at the entire system. And second of all, is say like, well, most CTAs will spend a lot of time looking at what is the correlation across markets, and do I need to have both of those markets in the portfolio? So how do markets cluster? Or, you could sort of say its principal component is cluster analysis, hierarchical clustering, or how markets are connected. But the problem comes in is that, or what we think is the problem is that is part of the portfolio construction optimization problem. What you want to try to do is think in terms of not correlation, but causal relationships. And also you want to think about how you integrate predictions with the optimization. So this is an area that's, somewhat obscure. People have been writing about it. This is what they call it decision-focused learning, or what they call that what you have to look at smart. We generally look at smart prediction and then we optimize, but we need to put the two of those together and sort of think in terms of how we optimize and predict at the same time. So this is the problem. If someone has solved this, more power to them, but this is what's keeping me up at night.
Sure. Well, that's perfect, Mark. Thank you so much for really a wonderful bouquet of topics that we covered today. And if people listening, like myself, really appreciate all the time and work you do in preparing for these conversations, do head over to your podcast platform of preference and leave a rating and review and show your appreciation for Mark and all the other co-hosts, by the way, that show up every week to hopefully produce some useful and educational conversations. You can, of course, also share the podcast with your friends. I think I created a link once called toptraders.com/share. That link probably will allow them to sign up and listen to it. Now, next week, Alan is joining me, but we will be joined by a special guest, a previous guest, and I'm sure we'll get into some topics that we have touched on before, of course, but in much more detail. So I'll leave you a little bit in suspense to find out who it actually is, but I think you're going to love him. And I was just going to say, if you have some questions for Alan and I and the special guest, but it's not really meaningful because you don't know who the special guest is. So let me skip that and just say that we love you coming back every week listening to us. And of course, you can also sign up for some weekly and monthly trend following updates from me and from Rich. So by all means, head over to the website and see what's available. From Mark and me, thanks ever so much for listening in this week. We look forward to being back with you in about a week's time. And until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.